Hey YouTube, I hope you guys are having a great day. Welcome to another video from Shesky TV. In this video, I'm going to do a fundamental analysis to see whether or not Google stock is a buy at their current price of over $1,700. So to do that, I'm going to go over their stock fundamentals, their business strategy, and their risks. So before I jump into the stock fundamentals, I want to say that I have been personally holding Google stock since 2017, and in 2020, I trimmed about half of my Google positions and used that capital to buy into another company. So this is going to be a very interesting video in that I believe Google is doing very well in some areas, but not very well in other areas. Let's jump right in. Looking at my own situation and risk tolerance, I have placed Google in my high to medium risk buckets in my personal stock portfolio. So I have a certain expectation of this company to outperform the market with a decent amount. And comparing the past 3 years' stock performance against my other holdings is actually one of my worst performing stock I have in this risk category, although it did beat the market in a recent year. 3 years in Google for me is about the right time to assess whether I have better options with other companies. As a result, I personally believe I have a better comparative advantage in placing my risks in other companies. That wasn't the only reason why I trimmed my positions in Google. The other reason comes from looking at the business from an investor's perspective. As an investor, I personally don't have the confidence in their management team's ability to make great long-term decisions on growth investments that will eventually generate a profit. I will discuss that point in a bit. However, with their existing dominance in online search and growing ad revenue, I think there will be growth in the company and the stock will go up in the long term, just very moderately. So this is why I'm still holding some positions in Google, and for those of you that are watching this could be a good pick for you if you're looking for a good value, low risk, and a large tech company. Continue watching for more. Google's price to earnings ratio is trading at 34, which is slightly lower than the S&P 500's average of 36. Price to sales ratio is 7.4, which is much higher than the S&P ratio of 2.6, and is also higher than the industry's average of 5. Their price to book ratio is 5.6, where the S&P is at 3.96. If we just look at these price ratios, it tells me that Google's stock is very similar to the average company in the S&P in terms of earnings, but is higher on the price to sales and price to book ratios. I will say their stock is not too expensive for a growing tech company, but I do expect this company to outperform the market in the long run. Google's parent company Alphabet has a market cap of $1.2 trillion at the time of this video, making it one of the largest companies by market cap in the United States. Their revenue has been growing exponentially in the last 15 years, which is very impressive. They have recently reported their Q3 earnings and crushed analysts' expectations. Google have achieved a Q3 revenue of $46.17 billion, a 14% increase year over year. Their net income has also grown to $11.25 billion this quarter, up around 59% compared to Q3 last year. Although ad revenue growth percentage have been slowing down in 2020, both of Google's revenue and net income have been on an upward trend. Google's $46 billion revenue from Q3 came from the following areas. Google Advertising, which comprises things like Google Search and YouTube ads, brought roughly $37 billion or 80.34% of total revenue. Google Cloud brought in $3.4 billion or 7.46% of total revenue. Other non-ad revenue of $5.5 billion or 11.86% of total revenue. Other bets that includes 8 companies Google is investing in, such as Waymo's self-driving car, brought $178 million or 0.4% of revenue. There's also hedging losses of $22 million that counted towards the total revenue. The current ratio, which equals to current assets divided by current liabilities, is also defined as a liquidity ratio that measures the company's ability to pay short-term obligations. Google's current ratio is 3.41, and you can see on this chart that their assets are growing as well as their liabilities, which indicate that they're still on a growth stage. Since the ratio is greater than 1, it means they have more current assets than current liabilities. Therefore, it demonstrates their ability to immediately cover their current liabilities. Google's debt-to-equity ratio, which is calculated by dividing the total debt by the total shareholders' equity, is 0.07, and this ratio is often used to evaluate a company's financial leverage. Having a ratio below 1 means shareholders' equity has the ability to cover all outstanding debts in the event of a business downturn, and in Google's case, it is way below 1, and in fact, over the 15-year period, Google's debt-to-equity ratio has never risen above 10%. Next is margins. On their latest annual report filings, Google have a high operating expenses of $127.6 billion compared to their revenue of $161.9 billion. Their operating profit margin is 21.15% and their net profit margin is 21.22%. On the surface, this is a pretty reasonable number considering they need to spend a lot of money on R&D. The gross profit margin is 55.58%, which is also a very reasonable number. Something I want to dive deeper on is where exactly Google spends money if 80% of their revenue is from ads. Remember from the annual report, they reported an expense of $127.6 billion. The cost of revenues accounts for 56.3%, which is very interesting. It includes content acquisition costs, data center expenses, and inventory-related expenses for hardware. R&D is 20.4%, which is a pretty huge chunk. Then is sales and marketing at 14.5%, general and admin at 7.5%, and, whoa, EU commission fines were 1.3% of expenses. This is not the first time Google has been fined by the EU, and it's not the only US company that has been fined by the EU. $1 billion is a huge amount, although it might just be chump change for Google, but as investors, we should care about the company's cash flows, because this money could be used towards R&D where it can bring future value to the investors. Having fines left and right like this brings uncertainty about the company's future net income and will ultimately affect the stock valuation and bring more volatility in the stock movement. Remember, stock prices are always driven by a company's future cash flows, and the company's future cash flows is strongly dependent on the company's ability to make strategic decisions. So with that said, let's look at the company's strategic positioning. Google's mission is to organize the world's information and make it universally accessible and useful. Currently, Google dominates the online search engine market at more than 86% in the US and more than 90% worldwide. Look at that huge gap between Google and its competitors. There is a huge space and they're not going to catch up anytime soon. If you used any of the other online search engine products like Microsoft Bing, you'll notice right away that Google is the superior one. Online search is definitely one of Google's core competencies and has been since it was founded in 1998 by Larry Page and Sergey Brin. However, since we looked at the financial statements, it's not actually the search function that makes Google money. When we look up something from Google, the service is entirely free. However, we expose ourselves to advertisers where they collect our data and displays more relevant ad in front of us. And advertisers use Google because there's a high internet traffic. So they pay Google money in order to get access to customers like you and I or anyone who uses Google services. With that said, let's look at some projections of ad revenue. This follows the same economic concept of supply and demand. As more users spend time online in a growing economy where unemployment rate is low and people get paid, ad revenue should continue to increase, which is what we have seen in the past. In 2020, however, the ad revenue growth was expected to decrease due to the economic slowdown due to COVID. Google, however, actually came in higher in ad revenue partially due to the increase in YouTube demand, which is up 32% year over year. YouTube, which is another huge success, was acquired by Google back in 2006, and today it is still dominating the online streaming services by far, and just like their online search, I don't think the gap is going to close anytime soon. This platform service also enjoys the demand-side economies of scale, where viewers can become producers and producers can become viewers. This creates a sustainable network effect that allows the user base to get bigger and bigger, and as the user base expands, it creates value for everyone in the ecosystem. The online streaming services market is expected to grow into 2023 and beyond, which is very good news for YouTube, who is currently dominating the market. Aside from these really successful core products, I also want to talk a bit about Google's failed investments, which is a lot in my opinion. By the way, if you're still watching this, make sure to hit the thumbs up button and subscribe to my channel to see more contents like this. On their Q3 earnings call, Google reported that their subsidiary companies like Waymo and 7 others collectively brought in $178 million of revenue. But hold on, didn't Google already spend $1 billion in self-driving cars since 2009? That's like more than a decade ago. The company also have this thing called Other Bets, which showed an operating loss of $1.1 billion. Now, if you were an investor, I'm sure you would feel that money just getting blown away, and you would question the management team's ability to make a good investment decision. Since 2008, Google had a really good opportunity to get a higher percentage of market share in the cloud business. They started 2 years after Amazon, who was first to market, but they lost their position to Microsoft Azure, who started 2 years after Google. My opinion is that they could have positioned themselves a lot better and focused more heavily into their cloud business and take a greater piece of the pie. Although their cloud revenue is growing, I think they left a lot of money on the table. Lately, I feel like Google's been pretty much a follower on things like smartphones. Google phones doesn't even rank up in the US smartphone market share, let alone the global market share. Google Meet, which is way behind from Microsoft Teams. I tried it just once because I do a lot of online meetings for school and work. It was so laggy, and of course I gave up on it right away. Google Stadia, which is a cloud-based gaming platform, I thought it was an awesome decision to penetrate this market because the US gaming industry is expected to grow. But after hearing about it during the end of last year, it suddenly died down. And players have reported upon release that it felt like they were testing this service in beta, and other analysts said that it felt like this product was an emperor with no clothes. Recently, Google revamped their Google TV service from their 2010 product, aka that's from 10 years ago, with new entertainment contents. Come on, we're like a year into COVID now, and where was the focus years ago when streaming should have been one of Google's core competencies? And as of 2020, Google TV only have a 3% market share. Google Glass. This was a complete product failure, and it seems like Google is doing some sort of a technology push model without actually assessing the market needs. It's no wonder why software engineers are happy working at Google because they get to make all these cool stuffs and they don't need to worry about whether or not it's going to be successful in the market. So they're obviously lacking some good business school students here. Overall, it feels like Google is really spread out amongst all these investments, giving $1 million here, here, and here without really focusing in one area to do it really well. Also, releasing a product early to the customers without it being fully ready will hurt them in the long run because it damages their brand reputation. Customers will begin to be suspicious when they try a new Google product. Based on the diffusion of innovation curve, they will have a harder time to go over the hump of early majorities because early adopters will shrink due to skepticism in trying a new Google product. And it's important to go over the hump because that's when you really start to gain market share. So for each failed product, it's going to hurt their future positioning when they launch new to the world products or if they want to reposition their existing products. I don't think this is how a world-class company should operate. Moving on into risks. I would say that Google is more of an ad revenue company making most of their money from their existing core products like online search and YouTube. So if their core products face fierce competition, it could mean really bad news for the company. But they have established a really strong brand reputation from their core products over the years to prevent that from being happening in the near future. Overall, I think Google stock is fairly priced. I think they have enough capital to spend on these moonshot investments and there's no financial risk of bankruptcy, but investors are not actually expecting this exponential growth from their moonshot investments, but rather investors are going to be looking for their revenue growth to align with the general ad revenue growth. There could be a relatively higher volatility in this stock because of their current EU situation, the antitrust issues, and also uncertainty in the management team's ability to make good investment decisions. But overall, I think Google stock will grow in the long term just very moderately due to the growing ad revenues brought in by its core business. But for me personally, I just don't think that Google is making the right strategic long-term decisions like they should for a world-class company. This is why I trimmed half of my positions in Google so that I can place my risks elsewhere and potentially generate a higher return. Will I be upset if their stock price went up? Not really, because I still have a position in Google. I'm just not going to be buying them in the short term, unless something changes my mind. Now, if I didn't have any Google stocks at the moment, I would probably purchase a small percentage of it relative to my overall portfolio. That's it. I hope you guys enjoyed watching this video. If you did, make sure to hit the like button and subscribe to my channel to get more contents related to stock investments and personal finance. Let me know in the comments below whether or not you think Google stock is a buy. Enjoy!